Welcome to today's Explainer. We're taking 6 major updates straight from the July 13th, 2026 Business News Strategic Briefing and distilling them down into a toolkit to keep your business compliant, competitive, and most importantly, resilient. Because listen, if you're running a company right now, the landscape is shifting pretty rapidly under your feet. We're talking everything from aggressive new tax enforcement to shifting AI workforce dynamics and even extreme weather threats. So let's break down exactly what you need to know.
We've organized this briefing into 4 main areas. First up, new tax rules for LLPs. Then, how HMRC is targeting tax fraud. After that, we'll hit AI adoption and hiring trends. And finally, surviving the flooding threat. All right, Section 1, new tax rules for LLPs. A massive Supreme Court ruling just put companies with limited liability partnership structures on immediate notice.
To really grasp the stakes here, we have to rewind slightly to the 2014 salaried member rules. Typically, LLP members are treated as self-employed for tax purposes, but they lose that status and get taxed as regular employees if they meet 3 specific conditions involving disguised salary, capital contributions, and significant influence. Now, the hedge fund Bluecrest Capital Management recently lost a huge Supreme Court case over this, and they might owe around £200 million because of it. That entire loss hinged completely on how the court defined significant influence. Here is exactly why Bluecrest lost. For years, everybody kind of assumed that informal, de facto influence was enough. Strong performance, personal clout, or making day-to-day operational decisions. Well, the Supreme Court just totally rejected that. They ruled that significant influence absolutely must come from legally enforceable rights written directly into the LLP agreement. You need an actual formal voice and high-level, business-wide strategy. If your partners don't have that legally enforceable power on paper, you might want to reassess your partnership agreements like today.
Sticking with compliance, let's jump into Section 2, HMRC targets tax fraud, because they are aggressively tightening the net.
We are seeing a massive crackdown right now on what's called electronic sales suppression, or ESS. This is when people use hidden software or devices to manipulate their point-of-sale systems to hide transactions and dodge taxes. HMRC sees this as a rapidly growing threat, especially in small retail, takeaways, and hospitality. Bad actors are literally modifying these systems just to hide sales from the taxman, and the government has officially had enough.
So what are they doing about it? The government is consulting on some incredibly heavy-hitting countermeasures. We're talking strict, uniform software standards for all POS systems. The big one here is a mandatory, unalterable transaction log that uses an encrypted chain. They also want to set up a UK-wide register of these systems. Essentially, they want to make it compulsory for small retail and hospitality to use certified systems, outright outlawing any till that doesn't meet the new standard. But it's not just sneaky software they're going after. It's also careless self-reporting. Right now, making an untrue statement for an indirect tax like VAT can land you in prison, while HMRC wants to introduce a new criminal offense for direct taxes, like income tax, with up to 2 years in prison and unlimited fines for reckless statements. And the craziest part? They explicitly gave an example of claiming a massive tax relief without properly reading the guidance, just assuming it'll, probably be fine. That mindset is now literally targeted as a prosecutable offense. Probably be fine is definitely no longer a valid defense.
Okay, let's pivot from taxes to the workforce. Section 3, AI adoption and hiring trends. We've got some fascinating US data that totally flips the script on the whole AI is destroying jobs narrative.
I mean, we've all seen the massive layoff headlines from tech giants blaming their AI investments, right? But a huge study analyzing 21,000 firms found the exact opposite trend overall. Companies that adopted generative AI actually grew their headcount by 10.2% over the 2 years following that adoption.
But the devil's in the details. This growth didn't happen for companies just casually dabbling in basic chat subscriptions. It applied to high-intensity adopters. These are the companies in the top third of AI spending, which paradoxically was only about $30 a month per employee, who invested in advanced productivity-boosting models like coding agents. And get this, they saw entry-level headcounts grow by a staggering 12%. The real takeaway, though, is that this wasn't instant. There was a 6 to 12-month incubation period before the hiring spiked. It takes time for real AI integration to filter through a business and actually stimulate growth.
Now, bringing it closer to home, the June UK report on jobs paints a slightly more cautious picture. Subdued business confidence is driving a massive shift. Permanent roles are declining, especially in retail, though nursing and engineering are still growing. On the flip side, temporary roles are rising at the fastest rate since April 2023, heavily in blue-collar sectors. But here is the really interesting catch. Even with more candidates on the market, starting salaries and wages are still climbing across the board. Employers are essentially having to pay a premium just to secure that scarce, top-tier talent. For our final section, we are zooming way out to the physical environment. Section 4, Surviving the Flooding Threat. A new Bank of England working paper just highlighted a massive external risk to UK businesses.
Flooding is absolutely not just a hypothetical, maybe someday risk anymore. It is now the UK's largest source of physical climate risk, costing the economy an average of £2.2 billion every single year. And the exposure is terrifyingly concentrated. Nearly 1 in 10 UK business premises are sitting directly on vulnerable floodplains, often because companies were just looking for cheaper land.
The stakes for SMEs are just catastrophic. The Bank of England found that in the year a flood hits, small businesses see a 32% increase in their likelihood of just terminating, shutting down completely. For medium firms, it's a staggering 43%. And even if you survive, you're looking at sharp declines in turnover, employment, and assets, with persistent liquidity issues haunting the business for a long time.
So, you need a critical action plan to protect yourself. Step 1, assess your specific postcode risk using Environment Agency maps and register for their free automated alerts immediately. Then, map out your continuity plan. Don't just think about your office. Think about your supplier vulnerabilities and your IT workflows. And strictly audit your insurance coverage for prolonged business interruption, not just physical damage to the building.
For the physical site itself, elevate your critical assets. Get those servers, electrical sockets, and vital documents at least 1 meter off the floor. Bolster that by installing purpose-built flood doors and improving your site drainage with things like permeable paving. Finally, you have to plan for the recovery, not just the impact. Have a detailed post-flood cleanup checklist and a safe power-up protocol ready to go. You really don't want to be figuring out how to safely turn the lights back on while standing in the dark and contaminated water.
We've covered a lot of ground today. From the Supreme Court's aggressive new stance on LLP structures and HMRC's zero tolerance for that probably be fine mindset, all the way to the AI hiring incubation period and the literal $2.2 billion existential threat of flooding. Taking all of these July 13th business news updates into account, I want to leave you with this final crucial question. Is your business continuity plan actually ready for the realities of 2026? Thanks so much for joining me on this explainer, and I'll see you next time.